So as part of our case study series on some of the most challenging questions that financial institutions and their lenders are posed with, in this one we're going to look at a situation where a client is buying a larger home, and in the process they're selling a home that's going to generate some significant cash. Their goal would be, of course, to put all that cash down towards the new house to lower their payment. But yet their most important goal is their long-term wealth preservation and creation. So how would we address a situation where a client is trading up, buying a bigger home, and whether or not they should make the max down payment or not? The way we'd approach that here is it's a purchase, clearly, from our plan type. So we want to put in a purchase. The contract price is $1 million, and they're trading up to a larger home. Now, we'll keep all this generic. Let's just go ahead and adjust our income here to something that's probably more accurate, self-directed income, etc. But the real goal here was the client wants to look at a $1 million home after selling their current home. The proceeds will be provided to $500,000 from the sale. So they got $500,000 coming free and clear from the sale of this home. And they're buying a $1 million home. Should they put $500,000 down as a down payment from the sale of their current home? Or should they put 20% down, which is the amount that the lender was requiring, and borrow the difference? That would allow them to place the difference in the investment account with their advisor. We can accomplish different goals, again, from closing cost goals to cash flow goals to wealth goals. If it's a wealth goal, then we want to look to see what is it that might make the most sense for this particular client. And to set that up, it's very easy. We click the Borrow tab. We're not using current liabilities because we know they're selling the home, and we know what we need, which is that they have $500,000 coming from the sale of that house. So if they put 50% down, it's $1 million home with $1 million contract price. They were interested in a 30-year fixed, 50% LTV, borrowing $500,000, and they were getting around a 4.5% jumbo rate quote on that particular product. Now the alternative here is a 20% down on the same property value and contract price, 30-year fixed, so we got an 80% LTV. The loan amount would then be $800,000, and the interest rate was going to be the same. It's going to be 4.5%. So that's our setup, right? We could add additional products if we wanted to, but we know that the down payment would be $500,000. There would be no origination fees. So if that's a default we have set up, we can take that out. Maybe assume that the closing costs might be around $200,000 on a purchase price, or $2,000 of this size. So we're need around $502,000. We know that they have $500,000 coming from the sale of their new home. That would leave them, again, coming out of pocket about $2,000. On the 20% down, they would need $200,000 down, plus their origination fees, and we can say that's going to be 0.5%. Closing costs, $203,725, and again, apples to apples always. We have the same amount available here, $500,000. So with 50% down, they'll still need about another $2,000 to make this work. With 20% down, they'll have about $296,275 left over. So does that work? Okay, it doesn't answer my question, but it tells me, well, yeah, I can afford to do either one, put 50% down or 20% down. But I'm really curious about the monthly cash flow difference. What are we really talking about here? With 50% down, I have a payment of $25.33. Again, this is a wash either way, so I'm leaving it out for now. We can add it if the client wanted to see it. With 20% down, I'm looking at a payment of $40.53. So what that tells me is this $296,275 costs me $1,520 a month. Now that's before tax. If I wanted to look at this thing a little differently, I could look after tax by expanding the after tax button and see that the $296,275 after tax is really costing me about $1,239 per month. But I'm just going to leave this right now simple pre-tax. About $300,000 is costing about $1,500 a month. Again, still doesn't answer the question, but it does tell me a lot more about the comparative nature of, do I feel better having $300,000 cash left over and paying an extra $1,500 a month, or having none of that cash left over from my investment account, rolling it all in and paying $2,500 a month, roughly $2,533. What's the important thing to you? If it's cash flow, then you're going to want to put the full 50% down, because that's going to save you more. You're going to have a $1,500 less payment. But if your wealth impact is your concern and you plan on being in this particular house for an extended period of time, then we would want to look at this a little bit differently. Again, I can take away the appreciation. We'll just say that the house doesn't appreciate for now. We're still using our 7% target after-tax savings rate over 30 years. And we look and can see here that if I look at the fixed payment of $40, $53, $48, and I do want to make sure that the cash that they deposit is $296, $275. So I've got that right here, $296, $275 at closing, because that's cash that I get to deposit into my account that I can't deposit here, right? Because here I only have to pay $25.33. Here I have to pay $40.53. So to compare apples to apples, I want the payment to be the same, because I'm going to pay $25.33 on my mortgage, and that difference I'm paying into my investment account. That way I'm spending the same amount each month. I can calculate this based on minimums if I want, if that's easier. $40.53 with $29,625, but the fixed is going to do all the adjustments for you automatically and make sure that you're paying the same amount over time, whenever that's possible. So over 30 years, what does that do for us? Is this a good idea? And again, I can go right to my bottom line here. I'm going to save the money, and putting that $296, $275 away is going to be growing at 7%. That amount initially is going to grow to be worth $2.4 million over 30 years. If the client saves the difference between these two payments, which is $15.20 a month, and they put that in an account at 7%, it's going to grow to $1.854 million. It's a difference of $500,000. So again, I could go through and see, what do I really need to earn here to make this make sense? At 6%, it's still worth $250,000 for me to leave that money in the side fund. I could even go through, if I wanted to, and get more creative and show things such as payments coming out of the savings, and look at what would happen if I took the difference, is $15.20 a month, out of my savings account so that the cash flow was the same. Is there still going to be a net payment savings or difference over that particular time period? So this again allows you to do a very powerful scenario in terms of comparison. I'll click on the repay tab here and expand that, because I think in some cases the visual nature of these scenarios is really compelling. Because what this is going to do is it's going to allow us to show how the mortgage balance here is going down, and that monthly payment savings, which is $15.20, I'm saving that monthly, it's growing at 7%. There's enough money in my savings account to be debt-free in 13 years and 1 month, if that's important. But if you think that you're getting further away from being debt-free by saving, in this case, I put the $296, $275 at closing into my savings account and nothing else. It's also, so it's starting here and growing at 7%. Notice how it crosses over at 11 years and 11 months. So even though I'm putting less down, because that money is compounding at a higher rate, my payoff here could be 13 years, 1 month. Here could be as early as 11 years and 11 months, still saving me over $250,000. So I might want to note here on these notes that it seems a $250,000 or greater savings is possible based on a 7% growth rate of the savings over time. Now, if the client wanted to see other alternatives modeled, could we do that? Could we show them other alternatives? 30% down? Absolutely. We would just expand this alternative here. Click duplicate 20% down. That brings everything here. Change the LTV to 70%. Keep everything else the same. Show this as 30% down. And notice I'm talking about this, but look at how fast we just completely modeled a totally new scenario, and it only took a couple of seconds here of clicking. And now I can see instead of $296, I have $196, $275. My payment difference now is only $1,000 a month. Maybe the client wants to split the difference here and say, I'd be comfortable with this $1,000 payment difference. Does that still make sense? The one thing I want to do is I need to take this 196,275 and do something with it. So I'm going to take the 196, I'm going to make 196,275. That's going to be a payment I make at closing. And where's that payment going? It's going to savings, because I have savings as my focus. If I click repaying, we're going to assume that that extra cash or cash flow goes towards paying down the mortgage. So I'm making a one-time payment here. So this is going to save me $259. This is going to save me $166. If the client feels more comfortable with that, that could be an alternative. This is the best option for them, but from a cash flow standpoint, if that's a concern, they want to keep that cash flow closer to $1,000 a month difference, then 166 is certainly nothing to sneeze at. I'm going to go over to the present. Maybe I want to keep this super simple. I'm not going to do AM tables. I'm not going to do anything but a cover, intro, and a 2-page summary. And now I'm able to bring this up, have my intro, have my summary showing the 50, the 20, and the 30. I'm proposing the 20, but the 30 is also going to be a benefit because we're always benchmarking off this left-hand column here at 50. And here I can see the payment, fixed payment levels, and the wealth creation difference over time.